All right, good evening, gentlemen, Clueless A Trading members. This is Frank, Clueless A Trading. This is a free strategic market update and stock, and we're going to discuss a few stocks too, take a few questions. Webinar session. The session will be recorded and uploaded to the YouTube channel. Full disclosure, this is purely for financial education and not for any solicitation or advice. So today is February 27th, 2017, approximately 8:25 p.m. Eastern Standard Time. And if everyone could just mute their mics for a quick second so we don't get any feedback noise from the back. Okay. So let me kick off by making a few important comments, which I think are very relevant to what's going on. Let me start off by saying that I don't think any of us, including myself, have an exact clue as to how far the market can run. I've always been a straight shooter, and thanks to my technical charts and all the precision forecasts, we are navigating this market in a very efficient manner, bar none. And but to sit here and project out to the technicals, which are easy to do based on the way I structure my charts, it doesn't mean we're going to get there. I'm not going out there and putting out a red flag of caution, but as a professional trader and as a tactical trader, I'm always looking behind my back and looking forward to capitalize on the movements in the market, long and short, primarily on the long side, obviously, as you guys have all seen for the past couple of months, and for people who've been with me for a while, for the past couple of years. Just want to make a point very clear here that this market right now is trading purely. This market is a direct function of preset, and I say that clearly, preset ranges that the machines want to trade in. Period. That's it. And those preset range, and that's a reason why I can, and a primary reason why I can structure my charts in a fashion which can benefit all of us, and certainly have been benefiting on every single day. And that's why these points are hit in such a precise fashion. I've said it before, I'll say it again. Humans cannot trade markets in such a humans cannot control a market in such a mathematical fashion, and it's only machines that can do it. And there's the reason why we have such direct contact points, inflection points, which lead to very profitable trades on the indices and on individual stocks. Saying all that, we are trading between some very, very specified ranges. We're going to go through that. It is not just mandatory, but critical for your survival as a trader, despite all the challenges that are thrown in front of us every single day, that you monitor and try to understand all the waypoints on the charts that I'm putting through. And people who are a little bit, traders and members who are a little bit more advanced, can also obviously use their own screens, which should be, to make a determination based on the internals, which are correlated directly with the externals. But a lot of the times, as you all know, the predictive forecasting that I do is totally based on the internal readings, and then the market gets there, and obviously you make maximum profits on those type of moves. I've shown that on an intraday basis, I've shown that on a multi-day basis, and I've also shown that on a swing basis. So if you understand the correlation and the interaction between the internals, and it's not always easy, I do admit that, but practice makes perfect. Well, not perfect, but close to, perfection as we can get. There is no perfection in this business, or any other business, if you ask me. But if you understand the direct relationship of how the internals work and all these stochastics, McClellan oscillators, the directional momentum index, the DMI, all that stuff, how they work with each other, it's going to make you a more profitable trader, and you do not always have to rely on every single specific tweet that's coming along, because the market throws a lot of curveballs along our way every single day, and we see that clearly, and every single week. So it's extremely critical. I mean, I just can't tell you how important and how critical to your survival tactical charts will become as we progress through 2017. And if you're not in tune with it and you don't quite understand the correlations and what you're looking at, not just the chart that I'm putting out with arrows and stuff to make it easier for a lot of novices. And if you're just watching prices and not watching what's happening underneath the surface, I can assure you, you are not going to survive. And that's that I've seen happen over and over again. Key point, do not just rely on prices. By the time you get that wowza statement coming in and kaboom statement coming into the chat room from atypical price watchers, I'm most probably selling, because the human brain is geared towards pleasure, pain or pleasure, right? So the pleasure comes when the stock is moving up 2, 3, 4 points, or the SPX calls are up from $2 to $4, $5. But at the same time, underneath the surface, the algos are just waiting to pounce, take all the profits, and if you're coming in late, as a lot of people do, they're just going to snatch that away from you. So when it comes to index trading, which is very profitable, it's like trading futures, intraday, or let's say overnight, or on a swing trade basis. But let's talk about intraday. When it comes to trading futures, you have to keep in mind that every single bar, and this is the futures chart you're looking at, every single bar and every single candle means hundreds of dollars, if not thousands of dollars, in losses or gains. Every single candle. Pure technical analysis is just numbers. I know as humans we can't detach ourselves from looking at the P&L statement during the day and feeling crappy or feeling too happy. I try not to be either one of them. I'm never too happy, because that's just a personal thing, because I don't think I've reached peak performance in what I do. If I was, I'd probably be making $100,000 a day. And neither do I get all maniacally depressed because a position is upside down, for no fault of mine. The job of a trader is to basically take a loss, do what they need to do, average cost lower their average cost basis on that particular trade, whether it be a stock or an option, depending on the chart pattern, depending on whether there's a possibility of a bounce, reflect bounces on oversold conditions, or just simply move away from that, shift into another position, make it back up. That's the goal. That's what I do every single day. If I'm down on a certain position, just like any other retail trader, I don't automatically hit the sell button. I look at it carefully. I see whether or not there's a chance of it, bouncing back, and that applies to the market. These markets you can clearly see here. And I know these are basic things, but what amazes me that even though these are basic things, a significant amount of traders and out there, and even within our community, Clueless Day Trading Club, fail to understand the volatility and what they need to do to manage their trading positions. Just jumping out just because you're down on something is the stupidest thing ever. Yes, you might call back on some, some of those old legacy rules like, oh, I'm down 20%, 10%, I'm out of the trade. Well, stupid. Within 3 minutes, the trade turns around, as you can clearly see here repeatedly. And this is just one snapshot from the 21st. Let me go back to, let's say, we go back to the 16th of February, right after Valentine's Day. And just look to see the amount of red candles and green candle reversals and red candle fallouts that you're seeing right in front of you. So that old thing that the old rule, and I'm not telling you to change your rules. You can do what you need to do. I'm just saying what works for me. So that old rule that that you got to jump out of a position because you're down on it. Yeah, all that works fine and good if the market was just a straight line up. If the market just went like this. And when it wanted to correct, it just went like this. It's never like that. And what amazes me and shocks me, and I say this in a helpful manner to all of you, is that so many traders and members just want these direct straight line movements. There are no straight lines in between the straight line moves. The market's gone higher, right? So you can draw a straight line just like that. But what's happened in between? Bear with me 1 second. Okay, that's better. So the market from this point, let's say, if you draw it on a linear fashion, it's a straight line. Sure it is. That's what you keep on hearing from the media, from maybe a lot of other services, who are just looking at straight out up and down. I think that's completely idiotic. They are not in tune with the reality of machine-driven algorithmic high-frequency trading black boxes. So it's a straight line. Great. Okay? Even a kid will understand what I'm going to explain right now. So what's happening during the straight line? You're going up, you're coming down, you're going up, you're coming down. You could have a possible breakdown, which didn't happen. Then you're just shooting up. Then you're coming down, moving around, falling, going up, coming down, could have gone lower, didn't do that. Went up, hit the channel, straight down. Just from nowhere, straight down. Hit the lower end of this channel, huge reversal candle, all alerted, all forecast, I mean not forecasted. I can't forecast volatility like that, believe me. I never said I would, I could or would, but I can give you the general direction. But alerts, absolutely. Big reversal candle, big move up. And each of these are good for 60, 80, in some cases 100% plus within on an intraday basis. Up and down. Then a movement down, looks like it's going to move up, but nope, big time drop. Everyone, absolutely scared and hiding in the cave. Big reversal. And then it gets here. So if this is the straight line up, did it get it? Did it go there in a straight line up? Absolutely not. Now, if you're telling me that you know that a lot of traders like to say, oh, I knew it was going to get there. No one knows it's going to get there. I've been the biggest bull on the market since 2009. And I've also called for some of the largest corrective movements, which I've correctly predicted and benefited of. So, but I never seen everything goes up in a straight line. So this is a straight line. This is what it did to get from here to here. Now, in order to navigate these type of movements, which are heavy volatility, okay, not that you'll ever hear it out there. Like they say out there, the famous last words, fake news. There's a lot of fake news out there about the market's just on a straight line up. You hear those pundits sit there and rehash the same old cliches. I wonder if they ever traded, if they ever really see what markets do? Or do they just look at the market on a 3-month basis and say, oh, it was here, now it's here, so it's a straight line up? It's all garbage. But if you really want to make the real money, you got to know how to handle volatility. You got to have the tools. And those are the tools that I point out repeatedly to all of you. Some of you are getting it faster. Some of you are getting it slower. And some of you are just not even attempting to understand it, which I think is a damn waste of your time and money, because you're not making money. So I can't even start to emphasize and encourage and push you all to really get serious about technical analysis. And you don't need to be some sort of guru out there where you have to draw the most difficult, complex charts that you won't even understand after you see them. There are charts out there I don't even understand that I put out there on StockTwits and other forums that I look at. I just want to make it simple, but you can't make something which is a complex, volatile market that simple. So I utilize a whole bunch of tools, as you all know. But at least you guys can, and I keep on pushing people to understand the different widgets and cogs that run the machine. So this is the most simple, and I'll move away from this in a quick second, but I do want to emphasize this so importantly once and for all, is that there are no linear markets. There are no linear markets. Every volatility, every pattern, he showed this, and this is what we got to this today. So if you think that's a straight line up, well, then you're smoking something you should stay away from. All right? So I think I made my point. So looking at this here, well, I'm going to get into the charts in a quick second. Try to keep this short. Is a couple of things very important about the markets. I know I sound like a broken record, but it's true. And even the greatest oracle of all time of investing, the Oracle of Omaha, Warren Buffett, saying the same things. So I feel somewhat privileged that I've been saying the same things, and this gentleman echoed them in his annual shareholder letter on Saturday morning. Massive amounts of underinvested money. Bunch of bozos on the hedge fund side who are basically wasting billions of dollars in taking fees in the 220 cut, 2% for management, 20% on the profits, which they're not even making. Constantly shorting the market, most of them, based on a huge bunch of reasons, fundamental, technical, you name it, and it's not working for them. One of the key things that I learned a long time ago, and of course Mr. Buffett said it very clearly, don't mix your political ideology with trading. Just don't do it. Markets, I've always said, United States of America, our great nation, has come this far, and the richest nation in the world, and we are on a per capita basis. Okay? Not the richest. I think some of the Gulf states are richer because they have a puny amount of people, 4 million people. So, what do you expect? And all that oil. But the point is, didn't get here because of ideology. It got here because of business and innovation. And America is run on business. That's my ideology. I'm a pure capitalist in the truest form. It doesn't mean that there's no faults in capitalism. Of course there's faults in capitalism. It's the best system that works. So the bottom line is, as long as American business is successful, as long, and we are the global leader overall in exporting and building the most innovative products in the world, which the world wants to buy because the world is growing. Whether one likes it or not, it's a globalized world. Can't get away from that. It's all about demographics. We're not growing our population at 20% a year. There are countries out there growing their population at 5, 7, 8, 10, 15% a year. They need things. They want that nice refrigerator. They want to drive that car. Everyone has the same basic needs. They want to have an AC so they don't burn their butt in 110-degree heat. And they're going to buy it from us. And they're going to buy it from the other developed nations. So as long as American business is successful, we're going to be fine. When American business falters, I don't give a crap what ideology is out there. We are going to fail as a nation and in our markets, period, bar none. So don't mix your ideology, regardless of what it is, with your investment thesis. Gotta respect what the markets are doing, as it has done from November 9th, and go with it. So you keep on hearing that, this is going to be that the State of the Union is going to be the end of this run. What the heck do I know? But I can assure you one thing. I'll give you certain patterns that I see, the corrective process that will come, and then we'll ramp up. I don't know when a real top in the market is. I can guesstimate based on my forecast, or estimate, I should say. But the fact is that it's not going to be the question that's on everybody's mind is, where is the top? Where is the top? It's like as if there's going to be like one big flash and it's the top, and boom, we're just going to end from there. No, it doesn't work like that. I've been in the market long enough to know this. Some of you have been seeing the market longer than I have. Tops are a rolling process, and that's why technicals and the tactical levels that I post are so important. In a rolling process, you come down, you try to retest the top, you fail, then you go back again, you maybe overshoot, and then you keep on trying to break that, and it doesn't, and then you drop, then you try again. But at one point, you start to see a rolling top. Well, we're in that rolling top type of situation with incrementally higher highs. That's what's really driving these so-called professional money managers and so-called hedge fund traders out of their mind. Maybe they should all subscribe to Pluto State Trading and actually start to see how the reality works. I wish I had the marketing power to go out there and promote my service to a lot of these people, because they would be just blown out of their minds as to the forecast and things that I've projected from months and months ago, if not from years ago. I'm not boasting, it's an actual fact. So if any of you have some real marketing ideas and stuff, talk to me. I'll put money in your pocket, and you can digitally market the service out there to what I call the lost tribes and masses. Let's get back to this. So we're in this rolling top type of situation, except we are poking higher and making higher highs. So it's the rolling top is kind of like being stretched out. But we're nothing, no index or indices goes, continuously keeps on making newer highs. So there will be a point, and we're going to talk about that. I've talked about that before, where we're going to have a substantial pullback. So the bottom line is that at this point, a couple of reasons. One, the shorts are getting blasted every time the market's coming down. When you see a move like this is when the futures were down 12.5 points. It certainly looked like we were going to come down and test the lower levels. I was expecting a move towards, it looked like we were going to break this. And I was expecting, I even posted that out, which reminds me, every single morning when I post those pre-market charts with all the ranges and stuff, you really want to effectively manage the trades that you're doing, whether it's index trading or whether it's individual stocks that are being moved around by the market. You got to focus on them. If you want to, if you want to remember, just write down the levels that I put out there, or simply copy and paste that chart. Well, you don't have to do that. It's right there on my real-time feed, so you can always go back and review it. But those are the levels that are very critical levels. So if this had broken, for example, then we would have the 2361. I don't know why it says 2261 here, or whatever the case. We would have very quickly dropped to the 2330 level, which would have set up, in my opinion, a very large dragon bullish type of pattern like that for a very sizable bounce. Except the algos decided that this breakout level here, which was back on the 19th of Feb, was good enough for a retest, because I've said it before, and I'll mention this again. Anytime you get a substantial breakout of a V-shaped or a cup and handle type of pattern, you can call this a cup and handle, that level is going to get retested. Just happen. So that's exactly what the markets did. And the next thing you know, it wasn't that pullback to the 2330 level, which I really expected, but it doesn't matter what I expect. And then I saw the huge reversal candles, and this was back on Friday, and then you saw what happened, and it was an extremely profitable day. So once you get something like this, obviously, you know, that's where the shorts are getting blasted. All right. So that's the second reason. The third reason is, regardless of all the bullish talk and oh, the market's going higher, I believe, in my opinion, from based on what I see and my conversations with some of my ex-colleagues and stuff, there is very minimal participation by retail traders, retail investors, as well as institutional funds, hedge funds. Mutual funds are active in the market. They are buying up their choice stocks, and but the level of participation is low. So there is fear out there, because fear is not just that fear of like the chilling cold feeling you get, you know, when you're terrified. It's also a feeling that, God, I can't get in here. You know, it's way too high. It's all this mental BS going on. Oh, it's way too high. It's way too high. Because the hardest thing one can do in a sharply trending upside type of market with these type of movements is to buy in. So ask yourself the question. You know, momentum trading requires a lot of guts, because you get this big fat candle. That's why the technicals help a lot. You get this big fat candle. I know this is going to, if this holds and it doesn't give back more than 50% of this move, that it's going to be another one. And that's why I go out there and said, okay, go ahead and buy that a higher strike. It's very hard to do for the average non-technical trader, because they're like, oh, I'll wait for a pullback. The pullback doesn't come. Because from what we saw here at the 2349 level on the E-minis, using this as a proxy, we didn't come back and pull back here. Yeah, we got a pullback, but that pullback was contained on this uptrend line at 2361. So anybody waiting around here say, oh, I can't really buy that because it just moved too fast. You know, the same old cliches that you hear, is still waiting around and left so much money on the table. So there's a lot of this happening across the board. My saying is the bulls are talking the talk, but they're not walking the walk. Everybody is trading defensive. Everybody. I'm not even trading offensive, and I trade, you know, pretty aggressively when I see the risk reward on my you know, that that is favorable, and I tend to be very aggressive on tactical low points, you know, when the markets pull back and all the internals and stuff are flashing, you know, buy, and no one wants to touch the market and the room is dead silent as I kid around. So the point is that these are the real main factors that are driving the market. The seasonal factor too. There's March. And this is what I think is going to happen. So here is basically the, without, you know, without really boring people to death with the same chart, here you have your short-term picture on the S&P 500 via the E-minis, and I structure the chart so people can understand where we are. So these channels, they're trading between the channels. It can come down to the bottom of the channel. It can basically be here on the lower Bollinger. And it's pretty easy to see. And I draw the arrows and stuff on the ones that I put out there. So easy for you guys to understand. Let's take a look at a slightly longer term picture. So this is drawn out, stretched out a little bit, even though it's the same time frame. So these channels are basically telling us that we could go as high as 23. You can see here. There's a third channel here that can be completed if we break out over 2373, rounding it off. And just visually look at it. If we enter here, we're going to get towards here. And that would be roughly 2390 or so on the S&P 500. 2385 is roughly 2390 on the SPX. So if I'm being very disciplined, which I am, and discipline means sometimes you leave some profits on the table because markets can go like nutty, right? So I'm looking at a bunch of stuff. I'm like, all right, I'm getting close to my line, so I'll take down my bulk of my positions, and then I see it zoom forward again. But that's okay because I'm not into the zoom forward business. I'm in the business of consistently making very nice ROI on the trades that I'm doing. It builds up nicely. So bottom line is that this could overshoot, absolutely can overshoot. And but the upper end of the channel is basically telling us 2390. So we close around 2370, 2390, 20 more points. You're looking about another 120 points on the S&P 500. Can someone tell me the 120 points on the Dow Jones? So the 120 points of the Dow Jones brings us to what round number?
$21,000.
There you go. So that's really what is the market basically is right now. You're marking 21,000 where they want to go for a round number. Will it get there? It's a high probability it can, and then the low probability it cannot. Maybe it doesn't, because everyone's thinking, not everyone, but let's say the group says 21,000, maybe it doesn't get there, or maybe it just kisses it and starts selling off like crazy. I can assure you, just like at 20,000, there was a big sell program in the market. I remember it hit it and boom, the market started selling off. There's a big fat sell program at 21,000 waiting to pounce because they've been pre-programmed before. So if I was somebody who's trading the market, which I do every day, I wouldn't be waiting that we get close to it. I'll take a whole bunch down. Why am I going to wait for that fat sell program to hit and then blow the market down 100 points in 5 minutes? Because that's exactly what happens. So that's the channel. So that's what we're looking at on a forward basis. So let's talk some dates here as to where I think what's going to happen. So we're right now, I've said it before, and I'll stick by it, that normally the 5 to 6 trading days, business days of the month, ladies and gentlemen, are big inflows. Standard mandatory procedures in the charters of most pension funds and mutual funds to basically put the month-end money and the monies that have come in through mandatory distributions into their 401ks and stuff that have to be deployed in the market. Oh, the other thing I want to mention to you, pension funds are severely underinvested. Pension funds have a charter of basically have to produce somewhere between 6 to 8% annualized return in order to meet their obligations. The largest pension funds in America are CalPERS, California Public Retirement Fund, TIAA-CREF, and a bunch of others. And guess what? They're all underinvested. And if they can't meet their obligations, not good. Because the charter says you have to meet those pension, you got to send out those pension checks. So they got to make money somewhere. So that alone can boost the market up another 5% if they rush in. So whatever the case, you are, let's look at some dates here. So the first 5 to 6 trading days are, and again, we'll have intraday volatility, no question about it. But I'm giving you the broader picture. So let's do some date counts here. Tomorrow is the last day of the month. Expect volatility, period. I would be, from a trade management standpoint, if the market pops up and goes and rushes, let's say, up by 12 o'clock, 1 o'clock, like, up nicely, I would basically take down some nice profits, especially on the high momentum stocks. The Goldman Sachs's, Priceline is a huge winner, up to 1,700 now. Type of high momentum stocks, which trade within a range. Amazon, Netflix, that type of stuff. Because the last day of the month, there's a lot of shuffling going on in the trading books. So for no reason, they'll be just like chop, chop, chop. So if you have some nice profits, don't be stupid. Take it down. Sit back. So that's the 28th. Then comes Wednesday the 1st. First day of the month can be a little tricky too. Okay? And Wednesdays generally is hump day, right? We know Wednesdays are normally red days. That's what we've seen so far. So if tomorrow's a nice up day, and let's say State of Union comes, I'm sure, he's going to blast out some great, big fat expenditure proposals. Let's see how the market interprets it. Because a lot of times the market will interpret it wrong or right and sell off. Like they say, buy the rumor and sell the news. So what if he doesn't keep up with his expectations of some massive infrastructure bill and stuff like that and doesn't give any specifics, which can happen? The markets will sell off 200 points in 2 minutes. And this channel will be basically the sort of the major resistance, and we'll basically trade between here and back towards the lower end, because that's pretty much what we did here. There's no guarantee whatsoever. There's no guarantees anyway in the business that we're going to enter this channel and head towards 2,400, despite the fact that the prices are pointing that way. And price chases will be punished. I'm telling you right now. So we have to watch these very carefully. So looking at dates again. So tomorrow is generally good. Last day of the month. There'll be some choppiness. Then you have the 1st, which is a toss-up. Then comes Thursday and Friday. I think it's going to end Friday on a strong note. Okay? Now, then we enter next week. Next week till about the 8th, in my opinion, which is next Wednesday, I think we're going to be okay. And then as we enter the middle of the month, which is after the 11th is a Saturday, so March 13th. So basically the time period between the 10th, which is the time period between, let's say, the 10th, even though I think the market's going to end higher on Friday, the 10th till the 14th, I would say, well, 11th and 12th is weekends, so it doesn't matter. So the 10th, 13th, and 14th, going into the 15th, like I said, just let's have the cautious, the caution flag out a little bit. Now again, nothing's in a straight line, nothing's in a straight down. I mean, if it blows up and if it's going to get up here and wants to overshoot, I'm always alerting you guys. But I'm just giving you the date time frame that the middle of the month, which is roughly from a business standpoint, is the 13th, 14th, and 15th, could turn out to be very choppy. We'll look at the other charts to try to determine that. Now, sorry, losing my train of thought here. But there's one kink in the fly in the ointment here for the bears to really win out. The 17th of, the 17th of March is monthly options expiration. Monthly options expiration in general, as we all we've seen it happen over and over again, is the run up to it is generally bullish. So the bears have a very small window to drag the market to any substantial degree down And that window is basically between the 10th and the 15th. That's about 3 trading days. 4 trading days. So whatever the case may be, the 17th, I think we'll have the bullish bias on monthly options expiration can lead up to any major dip around the 15th or so. A tactical dip, in my opinion, I think can be bought, but we shall see. The charts will tell me, and I'll interpret it and pass it on to you guys. So that's what you got to keep in mind. Saying all that, if it's an extended pullback, we have the look at S&P here. We can see here a different format. If it's an extended pullback, they will buy the market, because my experience working on the fund complex as well as on the money management side on Wall Street and on the mutual fund side in Boston, my gut feeling is that the first quarter of March, which ends on March 31st, they will try to print a strong Q1. It's great for business. It's great to keep clients and customers happy, mom and pop happy. And I think that's what they're going to try to do. So month end, I believe the first quarter of 2017, which ends on March 31st, is going to be a positive, strong finish. But in between, like I said, it's not a straight line up. You're going to see a lot of zigzags. And looking at this quick picture here, going back to February 1st, which is right there. That was February 1st, okay? The big move up, we caught that nicely. Markets opened up 12 points higher. And from February 1st, this low, we have been trading on this acceleration channel. These technical channels and stuff have not only saved me tons of money, but have made me substantial amounts of money. It's so defined. And I'm very clued into it, no pun intended. And all of you should be. It's not that hard. So let's say, for example, we break this channel, then you're looking at 2330, which, if you remember, was the last waypoint, which we never got to on Friday, when we were supposed to get to about 2340 on that futures opening down 12.5 points. So whatever the case may be, this uptrend line that I've drawn is a major level of support. So 2330 should be marked in your books as a point where, if it breaks, we could have a very quick fall down into the 2280 level. Okay? And 2280 level from 2330 is 50 S&P points. Can somebody tell me roughly how much that is on the Dow? No idea? 50 S&P points is roughly translates how much on the Dow Jones? You guys forgot already? Okay, great.
500.
Huh?
500.
Who said 500?
Me?
250.
Yeah, no, 500's a lot. You're telling me it's 10. The conversions is roughly about 5 to 6. So basically, 250 to 300 points. Correct. Yeah. So basically, 250 to 300 points. So I'm giving you some forecasts here. Believe me, these every time I've done that, with my group, a lot of the times it's come true, and it's pretty much, it's pretty mind-boggling. But 250 to 300 points. If we fall 250 to 300 points, where does it bring us to? Brings us to that nice mid number of 20,500. 20,500. Okay. So, and that would be if we fall here. That would create, in my opinion, a very powerful buying opportunity. In that case, we would have given back all of February's gains, because February started right here, right? So is it going to be a straight line down? Look, I don't know. If there is a massive calamity, a terrible terrorist incident, or all of a sudden we get into a real mini shooting match in South China Sea with China, the Those are the real, real events which can rock the market. Or something happens in Germany, something happens in France, sudden, like black swan events. We could drop very quickly, very quickly. All right, so just keep that in mind. But those, black swan events, just the way they suggest, are unquantifiable. We don't know. But this is the level that I'm really watching, the 2330 level. Barring that, if we keep on just kind of meandering in between this channel, then by the end of the month, like I said, they do want to print a strong first quarter. Anybody who's been in the fund management business, I don't think any of you really have, it works in a very different way. They got to write their paychecks, and they are going to take it there, one way or the other. So if it does this, then we are looking at, again, the good old round number of 2,400. Markets shooting up over 2,400, I would think, would be a little bit too nutty, a little crazy on a straight line up, but you never know. All right. So once it hits that channel, then we could basically be, moving higher, doing this. I know April's going to be rocky. In fact, April 15th, tax day, prior to that, there's a lot of selling. Got to pay taxes on gains. Whether one mom and pop likes it or not, their mutual fund portfolios are up nicely. And they got to pay taxes on realized gains. And maybe some deferred taxes on unrealized gains. I don't know, depending on what type of structure they have. So the bottom line is there's always selling at that time. So April's a rocky month on I think, downside bias. March upside is intact, in my opinion. After the slight jitters we're going to get middle of the month. So saying all that, you're looking at roughly 250 to 300 points from here. But from where we are right now at 2370, I'm rounding off the numbers, down to 2280 is 90 points. Times 6 is, as whoever the gentleman who said that, from here down to here, which I think is going to be the corrective pullback, pretty certain about that, is 540 points. It'll feel like the good old bad days when you get a 500-point pullback on the market. Because what's happening is the market does this all the time. I've seen it happen since back in the 1999, 2000 period, when I really started to work on the money management side. I joined Wall Street in 1996, but learned and started to really see how these things work. It took me years to fully understand. And it massages your head. So people it is a fact, they are not fully directly actively attacking the market. They're starting to feel a sense of comfort. That's known as the fifth wave, as I've shown in my other videos. Okay, the fifth wave, or you can call it the third wave from the November lows. It's a fifth wave from the Brexit lows in June 27th. We're going to take a look at that in a second. So the fifth wave is where the complacency comes in, and bang, that's where they hit it. Okay, there's also European elections in France, and also in Germany, and the French ones are very important because that's another Frexit type of situation if Le Pen wins. Big nationalist, but she's kind of a socialist nationalist, which is like really dangerous, seriously. Okay. So she's got some really big socialist policies. So that's going to really shake up the Eurozone in a big way. And that's going to affect us too. Anyway, the bottom line is that you have a 540-point drop here. So to clean this picture up, this would be a powerful buying opportunity. And then if the market does want to go down, it's going to first try to come back and try to enter the channel. If it fails, it's going to be a fast move down. It's not going to be a straight line down. But in between here, in between the volatility, that's the level that I'm looking at, 2280. That's roughly about 100 points. And generally on a large scale type of correction, on an intermediate type of correction, if we, let's say, go to 2400, and we drop to 2300, 2280, 2300, whatever the case, you're looking at a 4.2% correction. Okay? 4.2% correction. Intermediate corrections, which flush out a lot of the froth, are generally 4%. Just remember that. 4% corrections, okay? 10% correction normally occur once a year. And it's not in a straight line, 8 to 10%. Those are big ones. The 4% might feel really frightening, but it's a good one. It flushes out a lot of stuff. So expect a 4% correction, in my opinion, sometime in April. You can make a lot of money on those if you're situated right. And it's not like you see it and say, okay, that's it. Because the first move down is the false one. They suck you in and then they drive the markets higher. You're like, what the hell? This market's nuts. And then they take you out and then they drop it. It's always like that. Okay? So let's take a look at, so we saw the SPX. Show you quickly the Dow Jones. So just keep this in mind, because these things are really, really important, because if you have a roadmap in your head, plus the help of all the other tactical charts that I'm putting out there, but you have the date count and stuff in your head, you can do very well. But don't shy away from buying powerful moving stocks, which might not even be affected. Many stocks, certain sectors might not even be affected. And the case in point, the biotech sector, okay, which is on the verge of a pretty large breakout. Look at this, okay? So let's take a look at this here. Every time we have come up the upper end of the Darvas, it's pulled back, okay? That's roughly around 305 on the IBB, the biotech index, the real juicy part of the healthcare sector. So at this point, my opinion, based on what I see, and we're going to take a longer term view here, on the monthly, we're starting to see a real acceleration. Look at that. Now somebody might say, hey, it's a real acceleration, it's getting into overbought zone. I agree, it is. But it is also, if you look at the monthly charts, which we normally don't look at as shorter term traders, let's take a look at what's going on. Despite this massive pullback correction that we have seen in the biotech index from 400, that's when the Regenerons were at 400 and AGN was at $350. It's going to go there. It's a great companies, great jewels of American industry. So bottom line is that despite all that, look at what's going on with the moving averages. All it's basically doing on a monthly basis since October of last year, the biotech index, despite all its crazy moves and tweets coming out from Clinton, from Trump, well, Clinton last year, drug companies are the evil Darth Vader of the business and all that garbage. The bottom line is, all it's done, it's basically moved and stayed between the 50 and the 34-day moving average. For longer term players like David Tepper, multi-billionaire extraordinaire, one of the best hedge fund managers out there, Jersey boy, moved down to Florida, big position in AGN, David Tepper. Okay, these guys don't care about what happens 1 day, 2 days. So bottom line is, if you look at it from a monthly basis, it's basically just trading on an upwardly rising 34 and 50 as SMA. Monthly SMA. Powerful. So my opinion is, once it gets here, this time round, you can see that it's starting to peak out and break out of the range, because this is the range it's been traveling in. Okay? It either breaks out or it keeps on doing the same old back and forth between the 50 and the 34. We don't know yet, but my gut tells me, given the accelerated nature, acceleration phase, and you look at how these lines are here, I'm looking at it very simply on the fastos, I mean on the stochastics, it tells me that we could have a breakout, and I think we're starting to see that, and they're starting to talk about it too. Carter Worth today was on CNBC, and Carter Worth is pretty decent guy, technical analyst, Met him a couple of times back in the old days. And like he said, healthcare, showed the biotech, and he showed it in his own way. Breakout. So where does the breakout take us? All the way to new highs? Absolutely not. It'll simply take us, like I said before, somewhere towards the 300, 350 level or so. So roughly a move of 50 points would translate into a move of roughly from where we are today of 17% on the IBB, 17% on the biotech index. Ladies and gentlemen, if you have the selected right stocks, the big ones, the Allergans, the Regenerons, the Biogens, that type of, those type of something, and then the mid-tier that's reflected in the XBI, as you know, the XBI index, the mid-tier, smaller cap, the Sareptas, Acadia, PTCT, Juno, Blue, so many names, Kite Pharmaceuticals, ICPT. You will see that 17% move on the from here to here on a monthly basis, mind you. Okay, while the market might be correcting on the financial side or the tech side, and rotations coming into this would mean huge gains in those type of individual stocks. Or like, if you don't mind, mention Reed, like he does, he buys the XBI and LABU and stuff like that, which is great. I like playing the individual stocks or the IBB calls. This is something to keep in mind. So to clean out this picture a little bit, giving you, this is where the breakdown happened, the big bad breakdown back in October of 2016. This is where I expect it to go, which would fit in with the upper Bollinger, which is still trending down. And once it gets there, we shall see. But this pattern, in my opinion, this very ugly, that pattern symmetry always happens. Don't ask me why. This big ugly red candle will be replicated by a big fat green candle that takes us into that 330, 340 zone on the IBB. So don't miss out on this. All right, play the selected ones you guys like individually, or the ones that I'm proposing that I suggest. The Clovis's type of companies, the Sarepta, you name it. I propose a whole bunch of them, as you know. Don't miss out on them. This sector could be where the rotation happens if tech starts to pull back. Now, another thing that Rip mentioned right now is about the debt ceiling. Yes, the debt ceiling's coming out too in April, I believe. So that's going to be another fight. And if things get really nasty, things are so nasty out there, right? That could again rock the markets. So yes, that's a very good point, the debt ceiling. So there's a confluence of different factors which will come into play within the next 6 to 8 weeks, which will shake up the markets quite a bit. Or maybe not. I don't know. But I'm just giving you what the factors are. IBB like a lot. Let's take a look at RUT, which was a huge winner consistently. Those calls that I gave you guys, the 1400, 1410s, $3.64 closing on Friday. They went to 943. Closed at 943. Okay, 1407, 1408 in the RUT. Please refer back to my charts. You'll see it. Those were the 1400s. The 1410s were $1.20. They went to $3.70. These are pretty substantial moves. So let's take a look at the RUT. Absolutely stunning chart. It really is. This is a monthly chart of the Russell 2000, which was left for dead, and every single bozo on CNBC and other outlets just kept on saying the Russell 2000 is overvalued. It's just going to crash and burn. All garbage. Okay. And the Russell, and just so you know, from a trading standpoint, the Russell calls and puts, the option premiums, are generally not as inflated as good old S&P, because most of the attention, remember, it's after all a business, right? these companies which do these ETFs and stuff, they're pushing up inflating the premiums and doing all that stuff. So these guys on the S&P, if they know the market's going to go up 100 points over the next week or so, or 50 points, you look at the calls and you're like, whoa, these are like $12? Well, obviously, because that's the guys that basically know it's going to do what it's going to do. You got to pay up to make money. So the Russells are a little bit more civilized, and you can buy these calls in that 3-4 range. And here is the other thing about the Russell 2000, which I've mentioned before. They move in $10 increments. So if it's at 1380, like I show all the time, you want to buy the 1390s, project out maybe 1400, but 1390. You don't have to buy in the money per se, like we do a lot of the times with the S&P, SPX calls and puts, because you want to see the highest level of elasticity or delta and gamma, right? Those are the Greeks for the volatility movements. So if you want to, when you're doing an option, you want to see which one produces the largest move for your money. That's number one key for every trader. You have a certain amount of money, you want to see which one produces the highest movement and the biggest ROI. So sometimes, you want to buy in the money, sometimes you buy out of the money. But in the Russell 2000, rule of thumb, you can buy 5 to 10 points out of the money without a problem. So here's your Russell 2000 on a monthly basis. It's a very clean chart, at least in my eyes, and it wants to go to 1500. She won the next 100 points in the Russell 2000. This is, of course, a swing chart. That's a monthly. That's why a lot of the substantial noise has been cut out, because there's a lot of noise once you zoom in and look at the hourly or the daily. But there's been 1 month, believe it or not, since November 7th. I'm sorry, since February. Okay? Since February of this year. There has been one single month, 2 months. One, which was June. Oh, I'm sorry, that's 2016. What am I doing? Since 2016, there's 1 and there's 2 months. This was in October. Aside from that, every single month has been a green candle. What is this telling you? A lot of real big money is going into the Russell 2000, regardless of all the garbage that you hear out there. And at this point, on a monthly basis, the Russell 2000 is heading for 1500. Start putting this on your radar. When I'm putting out those trades out there, or even without me, I'm not like, you're not doing every single trade I'm doing. You're doing some stuff on your own. You should, if you want to swing out, buy some long-dated calls on this. Only reason I don't go out there and buy long-dated calls and stuff is because I don't know what kind of volatility is going to hit the market over the next 30 to 60 days. So that's the reason why I like to keep things close to the vest, because these are volatile markets. That's the only reason. Otherwise, you can see how defined this is. Let's take a look at the QQQ monthly chart. All-time high was 120. I mean, the breakout level was 120. That was from March of 2000. Oh, I still remember those days. Everybody and their grandpas wanted to buy anything with a .com. That was the point, just so you know, from a market historical fact, was the point of maximum enthusiasm, 1999 to 2000. This was the highest level of retail participation in the U.S. stock markets. And then when this happened, they never came back. People say, oh, people were really excited in 2007. Bull crap. I was there in the pits. I know. We managed millions and millions and millions of dollars for institutions and for retail clients. Nobody was excited. This crash happened, which is minor, right? Minor compared to what happened in the dot-com bubble. Did not happen because of the stock market. The stock market was a result of the crashing real estate market, because everybody and their grandpas here wanted to buy real estate. Just the way now they're getting into that, oh, real estate's the most amazing thing. I can flip a couple of houses and retire in the Cayman Islands for the rest of my life. Garbage. We own property. I've owned multiple properties. I know. So that's the fever. So bottom line is, this was the 2007 to 2009 correction. Look how tiny it is. at least in the tech industry, compared to what happened here. So now we're back there, and techs are not immune, but they generally are less sensitive to interest rate movements because they have less debt. Just remember that. So when the rates start to really spike up, the banks and financials initially will go up, then they'll kind of stop. Maybe other sectors in the market, the dividend-paying utilities and bonds will get smashed. So all of a sudden, mom and pop's going to wake up and grandpa's going to wake up and say, oh my God, what happened to my bond fund? They told me I could never lose money, but look at that, you know? Well, you can lose big money on the bond funds if you don't hold it to maturity, right? We know that. So bottom line is that this is minor, and look where we are now. Tech is going a lot higher. Bigger picture. A lot higher. This was the tech correction, and then it was pretty much done with by 2012, and this is the acceleration phase. Nice little corrective pullback. Here's the next acceleration phase. Companies like Google, companies like Amazon, they're going to do $1,000. Even Tesla, minor correction. The guy who downgraded the stock, he was always a bear on the stock. He moved from 190 to 185. I mean, just think for a minute. He moved from 190 to 185 in his price target. Is this guy like, he's definitely smoking something. Like if he really wanted the stock, like, oh, I really hate the stock. Solar's like no industry and Tesla's just shooting off bubble rockets and they don't make real cars, they just make garbage. Then why did he downgrade the stock down to $100? What's the point of downgrading a stock $5? But he's a Goldman guy. So obviously it had an effect and the stock was down 11 points, which brings in some nice buying opportunity in my opinion. And I mentioned that and showed that on the charts. So aside from that, this price line is a $2,000 stock. Well, maybe at that point they'll split. So there's your QQQ, all right? Very powerful thing. Let's take a look at let's look at the energy index. Okay, looks terrible compared to the rest of the charts, right? In my opinion, it's a buying opportunity to a certain degree. Exxon, ConocoPhillips, Enron Oil and Gas. Did anyone grab that at all? Anyone grab that at all to today? It's up $2.50. After hours, it's going to 100, which I said it would. Enron Oil and Gas, fantastic company. EOG. Anyway, so bottom line is, if you look at this chart here, from what it looks like, and this is obviously a far more complex, volatile chart, you got a very powerful support level here, and it possibly, if it breaks out of the 50 moving average, you got some move, you got to move up here towards 90. That'll push up a significant amount of the oil and gas operations, which should benefit tremendously under the Trump cutting of rules, regulation, and favored status for oil and gas companies. So this is another sector which would be a strong buying opportunities. Carter Worth today mentioned that too. Biotech and energy. So if you're looking for distressed property, you want to be looking at energy and healthcare and biotech to the areas which are not completely blown sky high, like the QQQ and the rest of them, and the Russell 2000. So another great opportunity. Pick and choose. Buy some of the name brand companies like EOG, Exxon. There's a whole bunch of them. Parker Drilling, PKD, and you're good to go. So bottom line is that we are, and those are the major sectors I just highlighted right now. So looking at this here, that's sort of my view of what I see going on. Let me show you a couple of quick charts here, which are important, things that you guys don't see or have access to. So here's a chart of the swing 533. And this is clearly telling me, this is showing me a negative divergence. That means a nice sell-off is coming. The histograms are diverting lower, yet the candle formation is going higher. The stochastics are weakening. Remember, the stochastic crossover, when I show them, you got to buy hard. And those come off some nice pullback type of situations. Even though here it was a minor pullback, you still got the stows coming down nicely. Here the stows are still moving higher. They're starting to curl down. This is telling me a negative divergence is taking place, which means, like I said, timeline-wise, we should get a thump middle of the month and then an April pullback. So this is kind of projecting that. This is fine for now. It's still moving back towards the 100 level. There's no signs of any major deterioration. So this is telling me that we have, like I said, they will end March on a strong note from what it looks like, in between some pullbacks, corrective pullbacks, which are going to feel ugly. So we got to be positioned right. So that's what it's showing me right now. So no signs of immediate breakdown, and this is where we are. This is on the swing 533. Let's take a look at the New York or the NYMO. Serious internal readings here, and this is how I'm reading the NYMO right now. So you guys should know this. You guys can pull this up yourself. Just type in dollar NYMO on stock charts. You can see this every night. It's updated at around 4:15 p.m. So on the NYMO, what it's showing me is that the upper Bollinger is 34, the lower Bollinger is minus 20. At this point in time, if we get a pullback and it goes to minus 20, let's say this shaded area, just collapses on the NYMO down here. S1 is at 34.94. So let's say it goes to 20 or 30, minus 20 or 30, buy, hands down. Because the Bollinger Band is telling us what ranges the New York McClellan Oscillator is trading in. You get set minus 75 like we got in the November elections. I told you, you got to buy the market regardless of who wins. And that was shown itself in the futures market, where we dipped 800 points lower on the Dow, halted it, markets open lower, 130, 150 points, and then it started to reverse. We were there. We played it like a fiddle. So when you see these minus 75 type of readings, minus 56, minus 61, you got to buy with both hands down. Just scoop it up or buy a bunch and just sit there, because the markets will have a huge reflex bounce regardless of what the news is. It's just the way technicals work. All right. So at this point, if you notice, we don't get these big ugly dips. Most of the ugly dips are contained at that minus 21, minus 20 level. So if we see one of those by, let's say, who knows, in the next couple of days going into next week, then that would be a buying opportunity. The stows, the full stochastics are also coming down. So it looks like it's starting to get oversold. So I'm watching this very carefully. 49 on the RSI is certainly not overbought. It's trading the midline. Once it goes towards 70, just little things, for people who are not really technically oriented should know. If the RSI hits towards 70 or overshoots, which it doesn't really overshoot, it hits 70, that means things are getting really frothy, and people and traders are feeling a little too good if they position themselves right and making money. Do not chase the market when you see the RSI hit towards the 65, 70 level. Period. You can't do that, because they're going to smack the market. That's exactly what happens all the time. Right now, we're kind of moving sideways, and if we get a real push up on the market, let's say by the end of the month or earlier, then we're going to see this move towards 70, and that's your sell point. Of course, this is just one indicator among many that I use. So this is fine. Another thing that I noticed today, and these things, it's my job to notice, is the fact that here's the pivot, and the pivot was at, show you guys. The pivot was at 6.5, and it closed slightly above pivot at around 8.64. You can see that. So that's a good thing. Remember what happens. You have a pivot, and I've mentioned this before, say it again, especially on the indices and such, even in a stock. Here's your pivot line that's reset every day automatically by on the system. You go over pivot, you move higher. You go below pivot, especially on the indices, SPX, RUT, and such. You go below pivot, you fall. It's really as simple as that. So I'll take a few questions, and if you have anything that I didn't cover, feel free to ask me. But I think I just wanted to give you guys a sort of bigger picture on a whole bunch of stuff. Questions, please. Anyone? Priceline, if anyone played it, this is an after hours picture. I did some a little bit of after hours trading on Priceline too. Of course, the calls I have, very few, like 1 on 2 strikes, but that's a lot of money. Very expensive. Bottom line is right after hours, if you're just tracking the candles, right here on TOS, on Thinkorswim, I used Quad as my after hours thing. Stock at one point came down and was only up 11 points, 12 points, 11 points. And within a matter of, this was 4:30, then it started to move up, and it came down again to 1653. So this was 4:45. This was 5 minutes later. It jumps up 40 points, 1650, 1680, 30 points. So let's say you bought 10 shares, right? 10 shares. She's made $300 in 5 minutes. Let's say you bought, 20 shares. Made 600. Let's say you bought 30. You made 900. Is it that easy? No. But if you really, it's actually not that hard. Just have to do it with smaller amounts, and you got to move fast. So this is looking really good. That's obviously a 5-minute after hours chart. Looking at the daily right now, I had projected the stock out. I have multiple charts on Priceline out there. I had projected this chart out to the upper end. Oh, 1 sec. Remove trend line. 1 second, please. Let's take this out. Okay. Oops, sorry. So upper end of the channel is 1832. Mid channel is what I'm projecting. Stock is going to go, if the momentum continues, which it should, because now the conference call is over and all that, right here, 1727. So people have missed out on the pre-earnings play. You still got room to move another 30 points, which is nothing for Priceline. So right there, that mid dotted line, it's a very defined chart. That's where it's going, 1730. If it breaks above that, the stock literally will go to 1800. And anything can happen with this. It's too powerful, but you have to follow the charts, and I've had them all out there. Any stocks that anyone wants to see? Because I know there's a lot of those charts, on my real-time feed, so it's no point in just replicating the same things. But does anyone want to see anything quickly on any one of them? No? Okay. All right, guys. So you got my point. I made it very clear what I'm trying to do to help all of you and help myself. Keep on bringing the referrals. I thank everyone who goes and spreads the word out there and get new people in. We have a long way to go, up and down. All right? So don't sit on your laurels thinking it's a one-way up and too many wowzers and too much excitement in the room. The markets are topping. All right? And dead silence, and no one wants to post anything or talk anything for hours or for a whole day. The markets are in a bottoming process. That's the psychological indicator you guys all need to know. Aside from that, stick to the tactical charts, stick to all the levels I post out there, stay flexible. Do not get heavy into anything big. If they're cheap lottos, sure you can. But if they're higher price options, don't go nutty. This market will hit, there'll be curveballs and missiles hitting us from nowhere for no reason. So if I'm changing direction on what I'm seeing, don't sit there saying, oh, he just suddenly changed his mind. No, I don't change my mind. I am just a very fast messenger and interpreter of what I see on my screens. That's all for now. Have a great evening. See you guys tomorrow.
Thank you.
Thank you.